The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Daryl Martin. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Daryl Martin.
All right, folks, welcome on back here to the Diagnostic Trading Hour. I'm your host, Daryl Martin, right here on TFNN.com. So let's check out where the markets are at. We got the S&P down about 14 points right now, so market continuing its decline. We got the NASDAQ down 23. We have the Russell down 14 and the Dow down 151 points. Gold's currently up 11.5. Silver is up about 1/3%. We got copper right now down about 30% on copper. Oil is down 41 cents on the day right now, sort of oscillating right there at its settlement level. We got natural gas is currently up 2.5%, almost 3% on the day. We got corn currently down just a few bucks. We got soybeans flying on down 17 points, over a 1% move there. Euro dollar is just down 10 pips. Pound dollar just down 22. Aussie down 9. We got the euro yen is currently down $1.17, so 117 pips right there. We got the U.S. yen down 82, and the pound yen leading the pack like usual, down 147 pips on the day. Dollar CAD is currently down 3 pips, and dollar franc is down 27. Last night we had, obviously, Obama came on, did State of the Union speech and all that. But the biggest news last night that came out was the Turkish lira raised their rate from 7 to 12.5%. So massive increase on their interest rate. Emerging markets falling apart. There's a high expectation. Who knows what will happen? But there's a high expectation that the Fed will actually even further accelerate its QE pullback. Going from, went from 85 to 75 last month. There's an expectation that they'll actually drop it to 65 on this announcement. We'll see if that's the case or not. But anyways, that's what a lot of the reports are out there saying. So we got some potential trades that we can do based on the FOMC. We've got to see if we have the right, the right pieces that we can put together in order to pull the trades off. As far as this morning, earnings that came out, we had Boeing come on out, got released here at 7:30 this morning, a little mixed bag on different earnings. We had the oil inventory was also released this morning, and let me pull that up for you. Oil inventory came out at 6.4 million barrels of inventory, so an increase there on an expectation of 2.2. So that should result in oil dropping on down. And that's the fundamental. You got to follow the chart, but that's the fundamental application of it. We got the FOMC statement, of course, coming up right here at 2 o'clock. And no major other news announcements tonight. If you're a New Zealand dollar trader, I guess the one major news announcement is the New Zealand dollar is going to be announcing their interest rate. And let's see here. We look at, what about this at the end of the day? Qualcomm in the NASDAQ there, high impact in the NASDAQ, is going to be releasing their earnings, and we're also going to have Facebook announcing its earnings right there, right around 4 o'clock. So 4 or earlier, we ought to get that wire release on the announcements, and of course, so use some caution going into the close there, holding positions, if you're a premium collection trader, etc., especially just every day at 4 o'clock, just be careful on premium collection for 4:15, just because of the earnings announcements happening. All right. So what can we do on the news? Well, we're going to have several trades. Let's walk through the potential setups and see if we can find anything that is going to work for us, okay? So go over here. I'll open this on up. We're going to go to the binary scanner. That's the main thing we're probably going to look at focusing on for. Now, we can also do the spread scanner. And we're going to do the spread scanner and we're going to do the binary scanner depending upon which trade we're looking at. On the spread scanner, we could look at potential straddle trades coming up. So, we need to know what our announcements are. And let's check out the FX pairs. So the FX pairs really to focus on usually are going to be the euro dollar. Okay, so we're going to select euro dollar and the pound dollar. And I'd say the Aussie dollar. So the reason I'm looking at those, I'm looking at, like dollar CAD, dollar franc. Problem on those is they're like 50% of the time they break 50 pips. So not real high. Aussie dollar, 75% of the time it breaks 50 pips. Average of almost 60 pips there. Pound dollar, almost 85% of the time it breaks 50 pips with an average of a little over 70 pips. And the euro dollar, 95% of the time it breaks 50 pips with an average of 73. Now understand that range, that 50 and 70 and all that, that's high to low. So if it pops up 30 and down 40, that's our 70. So we got to remember that when we go into the trade. All right, so now that we have those pieces together, we need to add in a couple of things. So we've selected our instruments. Now what I'm going to do is, since I'm looking at a straddle, I'm going to do a 1, and I'm going to do 100 on my risk, okay? And that'll get rid of a lot of noise that I don't really want to look at all. And then I need to look at ones that are expire after the expiration. Okay, so I'm not worried about 2 o'clock ones. That's not going to do me any good. So, we're going to go in and we're just going to say, hey, and at this point we want 60 minutes until expiration. That'll drop all the 2 p.m.s off of the scanner here. Now we just have the 3 o'clocks. We got to look at them and go, you know what, is it too expensive? A lot of time it is. We'll look at them though and we'll see. We'll put all the pieces together. We got that one right there. Let's see, here's there one that maybe is just a little bit. That one's a little bit closer. There we go. So that's a little bit more on the line. Now, here's something to look at. All right, and this makes for, just interesting trade reviews as you're pulling all these different pieces together. And what it is the cost. Okay, so like we expect to move about 58 pips. Well, the risk is about $50-something on them. And so that really makes it tough to go, hey, should I, do I want to do this trade? Do I not want to do this trade? And what I'll do is I'll go in here and I'll go, well, that's too expensive. I'm not going to do that trade. And here, I'll show you why. Let me, I'll fill in the data and then we'll come back and look at it as I'm going through it. If we bought the upper contract right now on the Aussie at 0.8788 and we sold the lower one at 0.8734 with the Aussie trading right now at 0.8757, okay? And our floor ceiling straddle is 8760. So 8760, that's that middle line right there, okay? And our expected move is 58 pips. What I'm going to see real quick, okay, once I do all the math on this thing, okay, is I'm going to see that my short side, my long side is going to say it's not in the range, my take profit. So like where I need to take profit at is 88.15. Well, actually, the range I expect is the market to move up to 88.15 on the Aussie dollar, but it's saying I'd have to take profit at 88.68. I expect it to move down to 86.52 is what I would need for take profit, but I only expect it to move down to 86.99. So the move is actually pretty huge. I'm actually needing like 80 ticks of movement for profitability on this trade. Now, when I say profitability, I mean the ability to make 1-to-1. Okay? So my first thing is this is not a trade that I would want to straddle. Not worth doing. But my second thought is, well, wait a minute. Well, if I went in and what if I sold the upper spread? Okay, so if I went and sold it, well, the quote right there showed me on the left side, 0.8782. That's the number we're seeing right here, 0.8782. And what if I bought the lower spread, so 0.8738? Then what that's going to do is there's actually 22 ticks of profitability pretty much in each side. And it shows me my break-even on the way up is 88.04. My break-even on the way down is 87.16. So I expect the range on this to go up to 88.15 or down to 86.99. So I do expect it to go actually further than the break-even price. 88.15 is a little bit higher. 86.99 is a little bit lower. So probably not going to be even my best Iron Condor. So Iron Condor basically being if it's too expensive, should I do the opposite? On this one, probably not worth doing the opposite on, just because that expected range. So I go, okay, well, no straddle, no strangle, or no straddle at least, on that trade, and no Iron Condor on that trade. And then let me uncheck the DAX over here. Okay, so now we're going to go down to the pound dollar. Go, what about this? Do we have anything that's lining up? And okay, so we got that 65.70, and we have another 65.70 right here. And that one's also, sort of expensive. So, and why is it expensive right now? Well, because the FOMC is coming out, so there's a lot more implied volatility built into the option. So, okay, well, what's my range expectation? 71 pips, so 0.0071. And then my floor ceiling is 0.6570, or 1.6570. And I'm getting that number from the lower price on the spread here and the upper price on the spread. And then if I go into buy, well, I'd buy it at 1.6720. If I went into sell the lower spread, I'd be selling it at 1.6541. So let me type that in, 1.6541. I'll show the screen up here after I type everything in. And then 1.6605 is the buy side. And then the underlying, we got the pound currently trading right around 1.6575. All right. And then what if I did the opposite? I'm just going to put all the numbers in at once. So 1.6540, actually 1.6601. If I decided to sell the upper, and if I decided to buy the lower one, 1.6543. Okay. So now I can do is I can take this and show you the results. Is it a good trade or not? Okay. So we got 71 pips. We got our straddle floor ceiling. We got the price we buy and sell at. We got where the market's currently at. Not in the range. Okay. Too expensive. Now, it could explode. It could go further. But we're looking for those consistent ones that match up. Okay. A lot of times you end up losing on these trades because you go in and, you just think, hey, that's a great trade because, maybe the risk lines up. Risk on this trade, I'm looking more for around $47. Okay. But this one would actually have a risk of 64. And so I see, I'd have to take profit on a 1-to-1 at 66.98, which is higher than my expected move at 66.46. Now my short at 64.42, which is lower than my expected move at 65.04. So we come back, we're going to talk about, well, what about an Iron Condor on this? Would that work? We did that on the last FOMC, and it worked out great. So we'll check this one out when we get back from this break.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pizzamento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pezzavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
Investors, Taz Market Research delivers to its subscribers expert commentary on the analysis of 15 different markets each day. Get this invaluable and timely information through the daily market research videos Taz Market Research produces each day before 9 a.m. The video analysis will include reports on currencies, interest rates, indices, metals, energies, grains, and more. You'll be able to gauge where high profitability setups are in each of the markets. Receive a free 2-week trial subscription to Taz Market Research videos on the front page of TFNN.com. Daryl takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
All right, folks, we'll come on back here to the Diagnostic Trading Hour. So I went ahead and I also put up the, so we got the Aussie, we got the pound, we got the euro. And during the break there, I went ahead and calculated all of them out. We're going to find that the euro is not in range, the pound is not in range, and the Aussie is not in range. So out of those three, I would not look at any of them at the moment. Now, those prices could come down. So you could always check them, like, say, minutes before the release and potentially do the trade. Could it still work? Yes. But do you want to risk that? I mean, you're talking about a lot larger move, like another 30 pips on top of the average move, okay? So, like we're needing 70 pips. We're expecting, like 58 on the Aussie. Over here, we're needing 93 pips on the pound. We're expecting 71. On the euro, we need a little over 85 pips. We're expecting about 73 on that. Okay, so we need more than the expectation. The closest one out of all of them, though, if we go, okay, well, we're expecting 73 on the euro. It has the highest percentage. The best one would actually, if you were going to do the trade, the best one would be the euro, because we do expect 73 pips. We need 85. That's 10 pips away. If we go over here, we need 70, and it's costing 90 to 93. So, I mean, that's like 20-something, almost 25 pips away, depending upon the direction you're looking at. So that's way over, which is not abnormal for the pound to see that. And then over on the Aussie, 58. So also about 20 pips, pretty high over. So out of the three, the euro not only has the highest percentage, it has the biggest move, and it has the least requirement. So it is definitely the winner as far as which one, the pick, I guess not the winner, the pick of the three of which one, if you were going to choose to do one, you could do it. But I would be, you need to be willing to give up about $15 of that. And so you're going to be looking more at a 2 to 3 reward to risk ratio, not a 1 to 1. So, make $2 for $3 at risk. So, just because you need to take profit earlier. And you need to take it at 37.74 or 37.33 would be the highest level to take it at. And so that's about 11 more ticks there you need. And on that one, you only need about 35.46 would be the goal. On the downside, it's actually a little bit rough. We need to move down to 35.87. So average range below. Actually, no, we need to move it 30, 40 pips below that. So the downside is going to be pretty rough on that. Personally, what I've found more often than not is, as much as I like to do some trades, if I don't see the trade set up, I just don't take it and wait for my right setup. Because at best, 50-50, that works out for you, And usually it's not even a 50-50 when you just try to force a trade. So you're better off just not forcing it. And that's why it's important to do the math. And the math, it seems like it's really complex. What we're doing is we're just figuring out what's the long risk and what's the short risk. We're adding them together, $57, okay? And we're saying $57 plus $29 is how much I need to make on the short side, because I got to consider that long side a loser. So I need to make that $29 plus all my risk back. So that would be the trade that, I'd have to make that many pips back. Or 57 plus 28 on the short side, on the long side, so if it flies up, I need to make $57 plus the $28 on the short side, considering it a loss, if it only goes up, to be able to make that money back. So that's all we're doing. And we're just adding that to the price we buy the spread at, or subtracting that number from the price we sell at the spread at. So that's what this 85 and 86 are. It's adding 57 pips plus 28, okay, or 57 pips plus 29 is how many pips I need for a 1-to-1. And then what I'm doing is I'm adding those pips from the price I bought at to get out on my sold, to sell out of my bought contract. And I'm subtracting 86 pips from the price I sold at to buy back to close out my short contract. And so that gives me, my take profit goals, my risk reward, my 1-to-1. And then for the average, range low and high, all I'm doing is I'm going, okay, how much do I expect it to move? 73 pips. Where is it at? Okay, let's add 73 up, and let's subtract 73 down. So pretty simple, not any big rocket science there. And go, okay, well, is my take profit goal going to happen before or after how far I expect it to move on both sides? And by doing that, it lets me know if there is a good trade. Now, what if you wanted to do an iron condor? Well, like we said, all these are pretty much looking like they're outside the range. So, basically right here would be break even at 37.14. But there is something unique about this. And we're going to talk about that when we come back, about if you were to do an iron condor, how could you set it up? Obviously, you're probably not going to have a completely guaranteed profitable trade. That'd be arbitrage. But you might have a pretty good possibility of having a good trade. So stay right there, and I'll walk you through that on this trade like we did on the pound dollar last time.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Andy Hecht's powerful weekly newsletter, the Technomental Commodity Report, is going up in price again at the end of this month. Andy's weekly newsletter has delivered multiple profitable trades for his subscribers, even including a triple-digit winner within recent months. Right now is a perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy will also be hosting a subscriber event on Thursday, January 30th, Seasonality in Energy and Agricultural Commodities, that you can gain access to by simply signing up for a free trial to Andy Hecht's newsletter, the Technomental Commodity Report. A 30-day free trial to the Technomental Commodity Report, a free 60-minute live online webinar with Andy Hecht, which will be archived, and you lock in the low price of $49 a month should you decide to continue after your 30-day free trial. Offers don't get much better than this. Act now before January is over and this offer passes you by. Sign up for your 30-day free trial to the Technomental Commodity Report today. Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
All right, here we are looking at this and just walking through it. So on these iron condors going into the FOMC, which sounds pretty nuts, but basically going in and being range bound, because we have such high volatility, such high premium, what kind of trade could we do? Well, if I look at this, I go, well, you know, I could actually make a pretty decent amount of money right there. That's 54 pips of profit potential, maximum profit potential on this trade, and the market would have to move, you know, a pretty sizable amount against me. So if I go here and go, okay, well, what's my, you know, move expected? You know, 73 pips. So, I mean, if I could bring in that much, that means, you know, I have a pretty decent possibility of actually profiting on the trade, because when you look at the FOMC, what happens? It pops up, and then it pulls back, right? So we'll be flat going up into the FOMC, and then we'll get these like up, down, to some crazy, crazy moves. When it flies down, have your take profit in on your short one. When it flies back up, have your take profit in on your long one. If it stays in the range period, you can be profitable on the trade. What was the most expensive one we looked at? Pound dollar. Okay, and it had a lower percentage than the euro dollar, and it had a smaller expected range on this announcement than the euro dollar. So if you wanted to pull this off on that pound dollar, this is the same trade I did on the last announcement. You'd go in, and this is sort of tricky. Don't mess yourself up, all right? Open up the ticket, and then flip the ticket, okay? So I go in here, and that's my sell. I'm going to make it a buy. I'm going to make my buy a sell, okay? So like right there. So I can make 67. The most I could lose, like, if you look at this, I can make $67 currently based on where the market is. The most I can lose on this trade is $123 on this side, but I make 40, so I can make 80. Well, on this one, the most I can lose is 110, but I can make 27, so again, we're right about, $70, $80. So on a $67 profit. So close to a 1-to-1, not too bad. As long as it stays in that range at all, I'm going to make money, and I only lose that maximum amount if the euro dollar goes all the way up to 67.20. Okay, I mean, and stays up there. So we don't even expect that on any, that's just not on our numbers. Okay, now could that happen? Yeah, of course it can. But I'm just saying that's the only way I take max loss. So my max loss is a low probability. It's just a massive move. And so you simply go in and you put the contract on, you'd sell one side, and you'd buy the other side like that. So pretty simple, pretty easy to do. Okay? And then once the positions are on, then go in and, one of the things I like to do is I go, how far away do they put some of these things? So I'll eliminate all my my filters. And I'll just look at some of these that are just really out of the money. Okay, so we'll even filter this. This is a good little lesson here. So out of the money, the market's just really, really, really flown. And go, how cheap do they get? About $8. Okay, that's sort of what I'm seeing. $4 on pound. I'm seeing $4, and meaning that the price is just a few dollars away from where the market is. Now, what if I go to deep in the money? I can do the same thing. And what I'm doing is I'm looking at where can I realistically set my take profit. And see how there's just a few dollars left in profit on the Aussie there. There's only 0 on this contract. So, basically about $5 from the higher low. So on this contract that I bought, I'm now going to set a take profit right here. And I bought it at 65.43, so I'm going to set a take profit at 65.66. Okay? So just, 4 ticks below the ceiling of that right there. So if it moves up pretty much at all, we're going to get the fill on that. So we get place order. And that'll get us out of the bot contract with a take profit order. Pound dollar flies up a little bit. Okay? We're going to do the same thing over here on the sold contract. We sold the thing at 66.07. We're going to buy it back at 65.74. So a little higher profit on that side, 65.74. And put that order in there. And now that order is in to buy back at 65.74, that order is now working for us. So now when the Fed comes out and the market goes nuts and it's flying up, down, up, down, up, down, I can actually get hit on both of these, take profit on both of them, and if the market for some weird reason stays flat or flies up, flies down, but not enough to hit my take profit, but just sort of oscillates in between, I still get to collect, a good chunk, if not all of that premium, depending upon where settlement is. So this is actually the highest probability trade I can do on this announcement right now. Because if I do a straddle, it has to move too far. If I do a strangle, it's going to be pretty expensive. If I was looking at iron butterflies, the risk is going to be high, the reward is going to be low. There's no good iron butterflies right now on the 30-minute still. You may have had some at 60 or 90, but at 30 minutes still, there's just no good iron butterflies available that are wide enough. They're only 10 ticks wide. They need to be, say, 20 ticks wide. So no good iron butterflies. The only other possibility we have at this point now is to look at strangles. So that's where we're going to go both directions. We're going to look at out-of-the-money contracts. And we're basically going to limit our risk to about $20 max. And go, okay, now on the 3 that we're looking at, okay, so we're going to drop these over here. And I already did all the calculations on my straddle, like where would, basically how high do I expect it to go? The highest I expect, say, the Aussie to go is 88.18. Oh, that's okay. So we got that right now. Look at this. We have an issue. 2 o'clock expiration. So we want to not do the 2 o'clock. That isn't going to do us any good. So let's go up here and make sure. Always get to do that minimum timed expiration. Now we need to bump this thing up to a minimum of 30 minutes. And I can even go out further and to see, what's available. And, okay, so I have an expectation that the Aussie will move if it just goes up, okay? It goes high as 88.18. That's really the highest I expect it to move. And notice this is 88.20. And then on the downside here, we got an expectation down to 87.02. So we could bring that one a little higher. We could bring that to like 87.20. That's not bad. And then what I'll do is I'll go up here in my simulation settings, and I'll simulate the range. Remember, what do I expect? I expect 58 pips, so 0.0058. So what if I did get a 58 pip move? What would I make on this trade? Well, I'd make $39 on this trade, and I'd lose 16 over here, so that's good. I'd make $43 on this trade, lose 12 over here, so that's actually good. That's a good trade. And I can even go down and see, is there a better one lower? Like, meaning, if I look at a, further out time frame, this is 88.40. That's too far. So that's not going to work for us. 8,700, that's too low. That's not going to work for us. So we know, no other time frames. I mean, and they're just going to get more expensive as we go out. So we don't need anything beyond that. Now let's go over, let's check out the pound. And I'm going to line up, I like to look at all of them to see which ones. I guess we'll hop to euro right now. Got that up. So euro, so we're expecting a move on the euro up to 37.33. That's pretty close there. And then move down to 35.87. Okay, so we'll be looking at one of these two right here. Is about a $5 difference. And then I can, again, use my simulator. Go, what's my expected move? My expected move is 73 pips. 0.0073. And click OK. So when I do that, then it'll tell me again how much money will I make. Make 45, I'll lose 17. So I'll net about, 28. That's pretty much about the risk on the trade. So that's not a bad 1-to-1. And again, if I go out and just check out further out times, is there an edge? Usually there's not going to be. And there's not. So we're definitely looking at the 3 o'clocks. Okay, and then the last one here, we got pound dollar, and then we can shorten it down and look at the trades. 66.46 is really what I'm expecting. Well, this is 66.60, and then 65.04. This is 65, so I'm really not even liking, like that right there is outside the range. I like my pound dollar condor better than I do a pound dollar straddle, strangle, or iron butterfly. So, no pound dollar binary trade. All right, so now what we'll do is we'll shrink this time down so we're not seeing all of these contracts because we found out that only the 3 PMs were going to work anyway for us. And we go, okay, well, these are our ideal contracts right here. So we got a buy on this one. We got a sell right here on this one. Okay. And what we're going to do is we bought this one on the expected move. We're expected to get to about $50. So I'm going to go ahead and we'll put our take profit over here at, well, actually, once I buy, I'll put my take profit at 50. So I'll put a placeholder on that one. On my sell, we'll go ahead and get in on this trade. Put that one in. Okay, so we're going to take profit on this one at 50. We're going to take profit on this one on the sold one at 40. So first thing, before I even worry about adding another trade on, let's do this trade correctly. So my sold one, let's buy back at the expected move there, 40 pips. Okay. And on my bought one, let's sell it at $50. Okay. Right there. make sure we're clicking the right one. There we go. Okay, so bought at 11. Yeah, so we're going to sell at 50. There we go. Perfect. Okay, so we're going to put that order in. All right, so now we do have a strangle on. So we have a neutral trade with the pound dollar iron condor. We have a strangle on with the Aussie dollar. And now we also have the euro dollar one we can check out. So this is about $30. I'll make 46. I'll lose 15. I'll net 30. I'll make 35. Oh, wait a minute. I'll make 30. I'll lose 15. I'll make 15. So this would be about a 2-to-1 risk-reward ratio. Because I'd basically, if I made $31 on this trade and I lost $16 on this one, then I'd net $16 profit, but I'm risking 30. And if I made, $36 on this side, but I lost 15 on this side, I'd basically make about 21, but again, I'm risking 30. So that's not as good of a risk-reward trade. I mean, it's an optional trade, but it's not as good of a risk-reward. Whereas these other ones, like we got these in here for like $11, $16, so like $26. So maybe a little bit better. Now, the only edge that you get on the euro dollar one, the one edge you have is it has the highest probability expectation of movement. So, we may get further than that expected move, but it has the highest expectation of movement. But out of all the trades, those are probably my two top picks. And the cool thing is we have a strangle trade and we have a range trade and a breakout trade on two different currency pairs. And just trying to figure out, what's the best way to, maximize, get the best contract. And that's what'll work, But if you go through it and you learn it, you're not going to be able to do all this at once the first time. But, if you work on the straddles and you just get that down, then, hey, that's pretty easy to identify, good or bad straddle. If you work on the, then you get those down, and then once you know what a good straddle is, then you can start figuring, okay, what's my range, high to low? Let's look at the binaries. Let's see if that's good, and see if there is a good binary strangle. If there isn't a good binary or a good spread straddle, and usually there are good spread straddles. I'd say majority of the time, like 8 out of 10, 9 out of 10 trades, I'm using spreads for straddling the news. The only exception is when the implied volatility gets really high, like it does for FOMC. And then sometimes, usually, like what I've been doing lately, is when it gets really high like this, I go the opposite direction because it's so high that the market would have to move really far for me to, lose on the trade, or at least to lose much on the trade. And I'm stacking the odds in my favor, doing a neutral trade. And right now, I'm basically just down bid-ask spread on everything. So just waiting on the announcement to come out. And, try it out. Obviously you got demo, you got live, do whichever one you want. Learn how to do this. Do it in, demo. One of the things, traders tell me, I hate demo. Demo doesn't mean anything. It's fake, and it doesn't matter how good it works for you. And that's true, but it's also not completely accurate. So we'll talk about that in a minute. There are some things about demo that you need to be thinking about. And we'll talk about that when we get back from this break.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, folks, we're going back here to the Diagnostic Trading Hour. So we got FOMC coming out in T-minus 6 minutes. Make sure you got your charts up, you're ready. If you got positions on, hedge them off, take them off, put your stops, whatever you need to do. If you're directional right now, just beware. It's going to go nuts, and I don't care what you're doing. You're probably going to get hit unless you got something like a straddle or a strangle or something going on. Or, you know, one of the things that I teach, I talk about all the time, this is a really, really helpful thing, is let's say you're going in, let's say you're long, you know, or short, or what, I don't know what direction you'd be right now, but with all the indices heading down, let's say you're, let's just say you're short the market at the moment, and you go in and you decide you want to hedge, okay? So if you're wanting to go in and hedge your trades off, then you could use the spreads to hedge right before the FOMC and allow yourself to have a little, you know, protection there so you're not just totally exposed in the market if you want to keep your position on, and, you know, allow yourself to actually make some money if the market does, you know, take off in the direction that you want it to go. So the way that you do that is you just go over here to the spread scanner, and then just, you know, reset your filters on a hedge. It's something that's very similar. You're going to say that you want a 1-to-1 risk-reward ratio. You want a, you know, $100 max risk. You probably honestly want at least a depending on what market, we'll just say $50 profit because that varies by markets on how wide the spreads are. And you go down and then it'll go, okay, well, I want the S&P, and then since I want to go, let's just say short the S&P right now, then I want to buy a spread to hedge it off. And I see here's all the spreads I can hedge with. I want to get the closest hedge I can with the smallest risk, and so I actually invert these two numbers where it says proximity and risk. I actually make, this is the risk if I'm hedging, because the risk is literally where I buy one and sell the other. And my risk is my break-even distance. And then I need to make sure it expires after the announcement, or it doesn't do me any good. So I'm also going to have to go in here and say, hey, I want 30 minutes or whatever till expiration, so I don't get those 2 o'clocks on there. And then go, okay, well, this would give me basically a maximum 3-point risk with a 6-point stop loss. 3 points to break even on the trade. So that would probably be my favored hedge right there, would just be the 3 o'clock expiration, 1775 to 1785, and buying that contract to hedge off. So if I went in and I went short the S&P right now at 1775.75, and I went in and I bought this at 1778.6, the most I could lose would be up to 1778.6, because then the spread would be making tick for tick everything, touching me off. Think of this just as a married put, married call type strategy. You're short the stock, you buy the put. You're long the stock, you buy the put. The difference is when you're doing options on stocks and futures and forwards and stuff, a lot of times you're having to go like 1 week or, several days or several weeks out. And so your delta's like 50, or it's way out of the money. And so you have this massive difference where you're going to put up a lot more risk. With this, you're going to get a delta. When that thing gets there, you're getting a delta 1-to-1. The thing expires at 3 o'clock, okay? And, you're not that far away. You're only a few points away. 28 ticks is, remember, it ticks in 0.1 on the Nadex. So 28 ticks would actually be like 2.8 points on the S&P. Well, you're going to have a 3-point stop loss at least if you're trading the FOMC. So very simple way to hedge off your trades. And I also show you here in the scanner how to hedge off 5 Nadex spreads on the S&P to 1 S&P future. So that way you get $50 a point in value. All right, that's a lot of information for one show. Hopefully you picked up a few tips. And good luck. Here comes the announcement. I will see you tomorrow.
Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com. Eastern legend tells of a fair maiden who was offered a rare gift by the king of the land, a bag of pearls. The king promised that she could keep the largest, most perfect pearl she could find with these 3 conditions. 1, choose only 1 pearl. 2, remove 1 pearl at a time, accept or reject it. And 3, if rejected, it would be lost forever. She began by looking at the pearls, passing on many special treasures. She delved deeper into the bag, and soon the pearls were replaced with pebbles. Sadly, she went home empty-handed. Folks, replace pearls with time, because we cannot go back even 2 seconds. We live in the eternal moment of now. So when now are you going to take advantage of my offer to you, a subscription to my daily investment newsletter service, Mastering Probability, where you can experience the most incredible pearls for trading and investing, the Rhodes Momentum Indicator and Strategy. The offer? It gets better. A 30-day money-back guarantee. Don't go home empty-handed. Mastering Probability. Available on the homepage of TFNN.com.
You're watching Tiger TV.